Investors Chronicle.
Welcome to the Companies and Markets Show, the podcast that gives you expert analysis on all the latest market and listed company news. I'm your host, Dan Jones, and this is what you need to know. Hello, everyone. There's only one place to start today. In just a moment, we'll be discussing the sweeping series of tariffs unveiled by US President Donald Trump yesterday evening. The market reaction tells you that the proposed levies were worse than expected, although, as we've been saying for months, that's partly because investors refuse to believe the president meant what he's been saying. That is not to say there's any logic to the move. Mark Robinson, Gillian Hoffman, and Alex Newman are here to talk about the slightly nonsensical way in which the tariffs have been calculated, as well as the fallout for countries and companies around the world. After that, we turn to funds. Our big read this week is on the shares that are the most popular picks in global equity funds, with a particular focus, for those seeking something a little different in these turbulent times, on companies that aren't just your standard US tech giants. Dave Baxter is here to talk about that. To wrap up, we will look at another controversy, albeit not quite on the same scale as a global trade war. That's Aviva, again proposing to cancel the preference shares that were originally sold to investors as irredeemable instruments. Jemma Slingo will talk us through the insurer's plan and how it compares to its previous aborted attempt to do so back in 2018. Let's begin with the big news overnight, though. Mark, maybe I'll start with you. If you can sum up what has been announced, please give it a go. What has President Trump announced overnight in terms of tariffs?
I'll do my best on this, and I would say from the outset that at least the president has been fairly consistent on this because he's been sort of banging on about the issue for the last 40 years or so. I remember from his time during the 1980s. Well, basically, there's a baseline tariff of 10% that's been levied on imports from all other nations, or 60 nations that are trading partners of the US. That comes into effect on the 5th of April. But there's higher reciprocal rates on specified trading partners deemed to have excessive tariff or non-tariff barriers from the 9th. That latter point in relation to non-tariff barriers will obviously have a major impact on the European Union. It's a rather blunt measure, as you alluded to before. So it's basically a country's goods exports to the US divided by its trade balance. Then you divide that by 2, and you don't set anything below 10%. So yes, it's a rather crude approach, and one that I guess that we could have expected. From April 2nd, China's the rate goes 34% rate on China, which already brings the total rate up to 54% because they were still laboring under tariffs introduced during Trump's first term and that were kept in place by the Biden administration. Japan are on the hook for 24%, the European Union on 20%, and 31% on Switzerland as well. So that's going to have an impact on watch sales and chocolates, no doubt. For the time being, Canada and Mexico are exempt, or the goods are exempt that are compliant under the USMCA. That's because they've been in talks with the US for some time now. And the president also reiterated an earlier announced 25% tariff on auto imports and parts.
Indeed, there's a lot to discuss there, given these are being levied on pretty much every country. The Switzerland point, Watches of Switzerland, is an obvious faller today based on that particular tariff. It's interesting to see who's been worst hit relative to expectations as well. The answer would appear to be the likes of Vietnam and Cambodia, partly due to the strange way they've calculated these tariffs, as if deficits entirely reflect trade policy, which is not really sensible economics at all. Vietnam, Cambodia, a lot of companies had shifted manufacturing out of China, of course, in recent years to these lower cost destinations. And now they find themselves being hit with particularly large tariffs. So there's been quite a big market reaction to that as well overnight.
Yeah, I think the bulk of the reciprocal tariff impact has been directed towards Asian economies, as you mentioned, and I guess that that move on countries like Vietnam, it doesn't actually fit into U.S. Policy in the region. Some of that production would have inevitably move back to the US anyway because of the changes that are going on to supply chains across the board. But it's weird, like a country like Vietnam, for instance, they're facing a 46% tariff rate. They're the world's biggest producer of Robusta coffee, which is the lower grade coffee used in instant coffee. And so the US is obviously a really huge end market there. But the way that they've calculated these tariff rates is sort of iniquitous, really, and it's going to have a pretty direct effect on consumers in the US as well, because it takes the effective tariff rate in the US from about 2.5% up to around about 9%, which is the highest rate since the end of the Second World War. You know, rather than the rate itself, I think the critical point here is going to be the duration of this current spat at the moment. It's a bit like inflation in that regard, because if this goes on for a month or two, I don't think we're going to see you know, a desperately difficult economic hit as a result of it. But if it drags on, it could have really sort of negative impacts on the global economy.
We're seeing some signs already. The ISM Manufacturing Index this week in the US, pretty much every manufacturer in there was complaining of various issues relating to tariff uncertainty, and that's before things were even announced, which doesn't really bode well for one of the potential hopes or goals of this policy to bring more manufacturing back to the US because of the uncertainty, in short. And also, as you say, if people aren't sure how long these policies will last, that won't encourage people to onshore that much more either. Why don't we bring in Alex? Why don't we bring you in with your thoughts on what's been going on and what the possible implications are? Because, of course, as Mark was saying, this isn't going to be the end of the story. We could see retaliations. We've seen some concessions, I think, overnight already from the likes of Vietnam in an attempt to talk themselves down or talk the US down from this extreme position. Well, what's your take on the whole situation?
I mean, it's crazy. It is, but I think it is. It's worse, I think, is the general consensus than I suppose markets and everyone watching were expecting. There's one point that really stood out to me on, I think it was Deutsche Bank's chief economist made this morning, is the nature of the way the tariffs have been calculated is that international trade is such a complicated field that, you know, as you kind of alluded to, there's so many complications and calculations with balancing things which relate to, you know, comparative advantage. You know, it doesn't make much sense at all, for example, for, you know, for a policy which targets Bangladesh, say, you know, the trade deficit that the US has with Bangladesh will be a pure function of the fact that there is a lot of garment manufacture in Bangladesh that the US just could not compete with. So it's essentially, you know, buying clothes from Bangladesh from a US consumer's point of view is sort of a no-brainer, because there's no way that they can reshore it and get the you know, the desired meet the desired goal of, you know, making American manufacturing great again, because there are some things they're just not going to be able to do which, you know, which don't either cause inflation or hurt consumers. So there's the scattergun element to you know, this kind of this deficit leveling idea behind it. But the point, sorry, to return to what the Deutsche Bank economist was saying, which I think really gets to the heart of why investors are starting to really worry, I think, is that, you know, one, as you said, we need to sharply discount the notion that everything Trump does is an opening gambit to a deal. Yes, there are going to be concessions. Yes, there are going to be deals. The UK might be front and center of that. We'll have to wait and see. But there's the broader point, I think, that there doesn't appear to be much structured planning for the economic policy decision making for the world's most important economy right now. So, you know, the emergent consensus is that US consumers and the US economy is going to be most hit by these measures. And the Trump administration either seems blind to this, unconcerned, or simply of the view, without much evidence, it has to be said, that this all just leads to near-term growth, better outcomes for everyone in the country. So it's a real concern that the policy is being enacted kind of on the fly with such enormous, hard-to-read ramifications for so many sectors, so many economies around the world. So yeah, it's kind of sometimes fear is irrational, but I think at points like this, it's completely founded because people are feeling very unanchored vis-a-vis globalization, trade.
Indeed. It does seem that the odds of a US recession, the US recession is certainly starting to be priced in much more on the back of this. Prices will go up. Clearly, it'll affect other countries as well, based on exporting positions and what have you. But it's not going to be good news. I mean, the US administration have said it as well. They've certainly, if not Trump himself, certainly other people in the administration have effectively said that the short-term pain is worthwhile for their goal of whether it's bringing manufacturing back or whether it's just trying to close the trade deficit, which, as you said, is quite implausible as well. They're prepared to accept some short-term pain, which is never the kind of thing you want to hear, because it's not easy to then remove that pain once you're in a recessionary environment. But let's talk about the UK, because you alluded to the UK there. The UK has been let off relatively lightly with a 10% rate, which is the lowest rate, which the government is saying is due to its diplomatic efforts. But on the assumption that pretty much every country, as we say, is the rate is being calculated by taking the trade deficit and dividing it by the amount of goods the US imports from that company, it would seem to be a purely mathematical calculation. What do we think about the UK position? I mean, we've spoken in recent weeks about investors looking a bit more favorably upon us because our economic policies are not so crazy as this one. But it's difficult to see a situation where we escape entirely unscathed if other countries are going to be embroiled in a tit-for-tat trade war.
With the UK, a point worth making as well is that our exports to the United States are predominantly invisible, sort of service industry exports. So we were always likely to be unaffected relative to some of the large manufacturing countries around the world, such as Japan and Germany, who rely on those sort of physical exports to a large degree. There are some potential negative impacts to the UK going forward because of the speculation at the moment that Rolls-Royce, for instance, they're reportedly exploring shifting some parts of their engine production over to the US to mitigate any potential damage from the tariffs. And it's quite doable given they've got about a dozen sites over in the US. They part of their production process is there already, and they've got around about 6,500 employees as well. That would be obviously a disaster for the UK economy, and it is just speculation at this point. To me, the worst thing about this, or potentially the worst thing though, is if the trade spat drags on and the Trump administration doesn't get the results that they intended, if there's any reshoring in terms of manufacturing, then the subject of trade quotas might join in the conversation. And having lived through the 1970s, I tell you, that's an even worse scenario than tariffs themselves.
Can I add to the question of the UK? I mean, you said relatively low down at the top, but I think actually if you calculate it based on their this odd metric in terms of just goods, UK and US are relatively balanced in terms of the deficit there. And I think even on the US calculations, there were more exports from the US than to the UK than they imported last year, meaning that if the logic were to be applied, we should be due a negative tariff. So the fact that there's a baseline tariff of 10% seeming seeming like we've got away with it a little bit. In theory, the calculation would suggest that the UK should be subject to much less. So there's two readings of that, I suppose. One is that that might make some sort of trade deal easier. That's, I suppose, the optimist's case, isn't it? That actually the UK can turn around and say, look, this has been a bit disproportionate.
Yeah.
But the other one being that we can't forget the 25% tariff on autos, which is blanket, and
Yes.
that is a big chunk of exports for the UK, and that could be really painful for it's easy just to look at the headline figures here, but you've got real pain for jobs, supply chains, all the companies that feed the UK auto industry, in the Midlands and elsewhere. It can have a real multiplier effect on the UK economy, and there's the potential to wipe out whatever anemic growth we had coming this year and going forward. So yeah, I mean, even if we got off lightly, as it seems, it could just take out growth for this year.
It's also going to open up an interesting carry trade, isn't it? So if I imagine there's going to be quite a lot of Italian wine grown in Dorset or something going to be shipped to the US, Montepulciano, Dorchester or something. It is going back to the 19th century. They tried all this before and it ended up in the Great Crash. I don't think anyone's particularly optimistic that this is going to end well. But I mean, picking up Alex's point about the auto traders, the auto manufacturers, there is already an accelerated process happening in Germany where car makers are essentially converting themselves into defense firms in order to get around the slump in sales. And you do wonder whether this is an incentive for a lot of manufacturers to think about whether they should be specializing in something else rather than continuing to chase an export market that's just going to tax them out of existence.
Julian, I want to come back to you in a second, but just to say you are right, Alex, of course, that the UK is affected by the baseline 10% tariff rather than that being a result of the calculation itself. It's purely qualified for that because that's the lowest possible tariff, even if you have a surplus. Julian, you talk about the automakers there. I wanted to talk about pharmaceuticals because that's an area that for now has been spared. And so there's been a bit of not really a relief rally, but the shares haven't fallen today, which on a day like today, as it's shaping out to be, is something in itself. Can you say a bit more about that? Again, though, this might not be the end of the story in terms of what we can expect for the sector.
Yes, I mean, it's not the end of the week yet, is it? So we don't know what's going to happen. But so basically, the pharma industry at the moment has won some kind of exemption, whether this is the result of lobbying on the part of the industry in the States, or Trump might be afraid of offending the Irish vote. Ireland is a major exporter of pharmaceuticals to the US market, for instance. I guess it also reflects that the complexity of where they buy ingredients. China and India are major exporters of basic pharma ingredients. So a lot of the chemicals that are used in medicines will be sourced from those markets, and you can't just impose a massive tariff on those without significantly disrupting the supply chains that had only just recovered from the disruption of the pandemic. So I think they were perhaps the one instance where they were alive to the possible chaos of a blanket imposition of tariffs on the industry. So yeah, a lot of people breathed a sigh of relief this morning, and all the major companies have kind of reverted to their traditional safe haven status when it comes to any kind of market slump. So you saw a lot of investors streaming back into pharma shares just at the moment as everything else is falling. So yes, it's kind of reinforced its natural hedge against turbulence. But yes, as I said, but the working assumption when you actually read into the debate on this is that there will be some further tariffs or some kind of trade imposition further down the line. But the possibility of a 20% blanket tariff on pharmaceuticals has kind of faded from view at the moment, probably because of the chaos that would have caused supply chains in the States itself.
Another relative beneficiary this morning, Diageo, is up a little bit, partly because, in the main, because Canada and Mexico have been spared any further champagne, Canadian whiskey, tequila from Mexico will still be tariff-free, and Diageo obviously has a lot of manufacturing there. That said, it has a lot of manufacturing in Europe as well, and the 20% tariff on EU goods will clearly have an impact there, which just, I think, goes to underline Alex's point that it's very hard. That's at a surface level, but it's going to be very hard to work out, even if you're in a sector that's sensibly been spared or one that's been hit in a certain way, to work out the full impact because of the way supply chains are so intertwined across the globe, and you've got to consider where a company gets all its supplies from and how that's going to affect it over the long term. So that some of this will only become known, I think it's fair to say, in the months ahead, and as we see companies reporting and warning, dare I say, as well. We need to move on. Sorry, go on, Alex.
I think Diageo just might be up because people are pricing in a lot more depression over the next couple of years.
More drinking. Yeah.
More drinking.
Indeed.
Well, and I just add something as well. It could be a case of serendipity as well, because I think they'd been struggling with excess inventory in North America and South America as well. So who knows?
Indeed. Well, we're going to turn to our next segment. I'm sure the tariff debate will run and run. It's not just a debate, unfortunately, anymore. Our big read this week is about global equity funds, whether they focus on growth or whether they're trying to produce an income for investors, and the shares that they most favor. Dave, you wrote this piece. Can you tell us a little bit more about your thinking and how you went about finding out this information? Because clearly, like pretty much everyone over the past few years, these investors do have decent stakes in various Magnificent Seven tech stocks, as we'll come to in a minute. But you were interested in finding out a bit more about the other kind of companies they're favoring at the moment.
Yeah, so I was interested in the idea of, I suppose, kind of spotting interesting investments just by seeing what the professionals are doing. But as you mentioned, perhaps looking at some of the ones that are less obvious than the likes of the Magnificent Seven. So in terms of kind of methodology, I basically looked through all the top 10 holdings lists of 20 major active global growth equity funds, so ranging from things like Fundsmith to Blue Whale Growth, Rathbone Global Opportunities, and many others. I then did the same exercise with global income funds, but because that's a smaller pool, I focused on just 10 major funds there. And I tarted up kind of I guess, how many times some of the most widely appearing stocks were showing up. And then looked at some of those names beyond the most obvious kind of culprits.
Indeed. The idea being, as you say, effectively it's an idea generation process that might throw up some interesting names, some companies that people may not be so familiar with. Let's talk about a couple of those, starting with Intercontinental Exchange, which proved quite surprisingly popular, you might say, in this small sample.
Yeah, so that's cropped up quite a few times. It operates things like stock exchanges. It owns the New York Stock Exchange. It also offers data services and has a large business helping banks to streamline their mortgage lending processes. Beyond that, it's keeping an eye on some emerging trends and has recently struck a partnership related to crypto products. So, yeah, quite an interesting one. I guess also you could view it in a similar way to London Stock Exchange, and thinking that perhaps it would benefit from the rise of AI, given it has, large proprietary data sets.
Yeah, that certainly seems a trend. We're looking outside the big US tech stocks, but it does seem fair to say that a lot of the other ones they favor, these global equity managers, do have a tech component to them, as you may expect, that be it data in this case. The other example of a pretty popular share, and again, this is for those who can pick shares from anywhere around the world, is the pretty mundane FTSE 100 company.
Yeah, so that's Relax. Generally, UK listed companies didn't tend to crop up so much in our lists, but Relax is a name that does so. And I suppose, as we've covered before, it does seem to be quite a safe pair of hands and has been doing a lot of good things recently. So it seems to have managed to make its way in.
Yeah, it's one of those kind of steady Eddie companies, isn't it? That I think if you're a manager, you're probably quite attracted to the prospect of decent growth, nothing going to shoot the lights out, but equally you hope nothing is going to go terribly wrong there as well. So perhaps that's one reason why that's starting to climb the rankings of, as I say, even those who can choose from companies all around the world. Let's talk about the Magnificent Seven, though, in a bit more detail, because clearly they do feature significantly in these funds as well. Of the Magnificent Seven, though, the most popular of the seven was perhaps, maybe to me, a little bit surprising. Can you say a bit more about how they ranked in these rankings?
Yeah, so I guess there's two joint most popular names. One unsurprising one might be Microsoft. That shows up in 13 of the 20 top 10 holding lists. But the one you're referring to, which is perhaps a bit more surprising, is Amazon. I guess that might be a bit more divisive. Amazon was interesting, I suppose, because a few years ago, Terry Smith's team dropped it. And then in a shareholders meeting in February this year, Terry Smith actually said that he still wasn't really sure whether it had been the right decision to sell it.
I mean, it's one of those shares, clearly it's had a good run up over the past couple of years. But equally, when you think of the Magnificent Seven nowadays, people tend to focus more on Microsoft to an extent, although it's struggled recently. Nvidia, clearly the AI story, Meta, likewise. But perhaps again, it just goes to show these managers who, let's face it, are struggling to beat the index right now because of the performance of the Magnificent Seven, because those shares are doing so well. These managers struggle to overweight them because they can only put a certain amount in each stock. Maybe they're thinking, well, let's go for something that is potentially less volatile, but can still enable us to keep up with the index to a certain degree. That might be an aspect of that. Can we talk about income funds now? Because as you mentioned, you did look at those as well. A lot of income funds clearly have had their heads turned by growth stocks in recent years too, despite their remits. But you were looking for shares that yield a decent amount and again appear in these funds quite regularly.
Yeah, so the original, or part of the original thinking for this whole piece was that global income funds, as you said, they often now hold things like Magnificent Seven members, perhaps because they're slightly afraid of underperforming the index, even though they don't yield much, or in some cases anything. So I've looked at some of the most popular names, and as you mentioned, looked at the yields as well and dividend growth over certain periods. And we're getting quite an interesting mix. So we do get some of those growth stocks like Microsoft, TSMC, Meta, Broadcom, but you also get some UK stalwarts. You get Unilever, you get Reckitt Benckiser. And again, we're seeing some names focused on the sort of stock exchange space. We've got Deutsche Börse, we've got CME Group. And beyond that, just to mention some others, we've got some pharma names like Roche. So it seems there is quite a variety of different options on offer. And as the feature shows, some of these do have some quite, attractive yields on top of that.
Mm. All this information is in the piece. Some big charts and tables in there of the most popular shares. So if this has whetted your appetite, do take a look at that. For now, though, we're going to move on to our final segment, which is about Aviva and a mini controversy here in some ways. It is attempting once again to cancel its preference shares. Jemma, can you say a bit more about that, why it's doing it, what's happening in short?
Yeah, so I'll try and simplify it. But basically, Aviva wants to cancel £450 million worth of preference shares on the basis that they are, in the company's words, an inefficient form of funding, which don't serve the purpose that they originally intended for. So essentially, the shares represent a very expensive form of funding that Aviva just wants rid of as it pushes ahead into its new life with Direct Line. But for shareholders, preference shares can be very attractive as they rank higher than ordinary shares, and it essentially means that you might be in line for a fixed dividend, and if the company goes bust, you're higher up the ladder than ordinary shareholders. So it's always a little bit controversial when a company tries to get rid, because shareholders are often not best pleased about it.
Aviva has tried this before, as I said at the top, 7 years ago now. That did not end well. They had to apologise. The FCA got involved. The chief exec left soon after, which may or may not have been related. This time, though, it has learned something from that lesson, seemingly, in that the offer is slightly different to shareholders.
It has. So back in 2018, it was a horrible reception for this sort of announcement. largely because the company was offering to pay par value for the shares when they're actually trading above that. So shareholders hated the idea. The FCA gave the company a bit of a slap on the wrist. Sort of the price of preference shares was driven down because of the whole scandal. So ultimately, that was something that Aviva wanted to turn its back on. So this time round, the company is offering a premium, which they're describing as fair and compelling. And just the mood around Aviva generally has improved a lot. So a new management team came in 2020. Shares have more than doubled since then. The market's pretty excited about the imminent takeover of Direct Line. So generally, the mood seems a lot more positive. And so far, the signs have been actually pretty good for the sort of cancellation being able to go ahead. So institutional investors had to vote earlier than retail investors, and there seems to be sort of strong support from them. So now Aviva will just be waiting to see what the other side of its shareholder base have to say.
It may well prove much more controversial, however, mightn't it, with private investors, because in some cases people rely on this income as their retirement pot or part of their retirement pot. These preference shares were advertised as irredeemable when they're originally marketed. There's clearly circumstances change, but equally these people at that time would have bought in on that basis. And you could have a situation then where the shares are all cancelled based on the institutional investors getting them over the voting threshold, whereas all those who really rely on them will be voting against, and that wouldn't be a very helpful state of affairs.
No, it wouldn't be great. I mean, retail investors are essentially thinking, do they want the capital gain now or do they want the long-term future income stream? And as you say, if people were planning a long way ahead and thinking, you can rely on these into their retirement, and suddenly this cat gets thrown in amongst the pigeons, I imagine a lot of people might be quite unhappy about it.
Julian, can we bring you in here? What's your take on this saga returning to life?
I don't think it's going to be the end of it, to be honest. We'll see how the vote goes. I mean, obviously, they've approached it in a much more sensible way this time. As Jemma alluded to, the premiums are quite over the par price is quite good. Last time around, they tried to hoist a price at par on for these preference shares, and there are not the only ones on the market. I mean, other companies might be looking quite closely at how this goes. I think the obvious one it would be NatWest, which has several prefs and permanent interest-bearing shares as well on the market, which are slightly different, but essentially the same kind of constant income stream. But they're much harder to cancel. I think that it'll be interesting to see the conclusions that the various financial directors come away with from the vote when it comes up. But even during the financial crisis, NatWest could not cancel these interest-bearing shares or stop the income. So they were a legally binding must-pay instrument. So that might prove a lot harder, I think, than this kind of straight preference share scenario that we have with Aviva. But I think a lot of people are going to be looking with interest.
One of the reasons Jemma Aviva is doing this is because the shares are no longer as important to them as they once were. Clearly, they tried once before, but there are other motivations nowadays as well.
Yeah, so it boils down to regulatory change, really. So if you're a bank or an insurer, you're required to hold a certain amount of capital on your balance sheet to basically act as a buffer if things go wrong, and that's set by the regulator. But by 2026, so next year, preference shares won't be recognised as eligible capital anymore. So companies really have an incentive to get them off their balance sheets because, as I mentioned earlier, they're an expensive form of funding, and now there's very limited upside for them to, have it clogging up the balance sheet. So it's possible we might see a bit more activity in this space, particularly if Aviva is sort of successful and manages to get rid.
And we'll find out very soon because the vote is coming up in the next few days and deadlines are a little bit earlier for private investors as well.
Yep, so the official sort of deadline is next Tuesday at about 1 p.m, I think it is. But investors have to tell their brokers or in their investment platforms a bit before that, so all the results can be fed in on time. And then there's a general meeting the 15th of April to look at the outcome.
Well, we'll see what happens next week, and we'll see if there are any knock-on impacts. Just on the subject of NatWest, our Bear Bull columnist holds those preference shares in the Bear Bull income portfolio, so there could be some consequences there too if NatWest does try something similar, albeit, as Julian said, the situation may be a little bit more complicated there. We shall see. For today, though, we've reached the end of the show, so thank you very much to you, Jemma. Thank you to Julian, to Mark, to Dave, and to Alex, and to our producer, Maddie Apthorpe. We'll see you next week on another Companies and Markets show.